Disney, like most stocks, as a result, of course, of the Pfizer news regarding the vaccine, has lost what looks like a little bit, of course, of the rally that it had, hitting what looks like about 148, and of course, now sitting at about 138, losing roughly about 8%, of course, since the recent rally, and of course, for good reason. If you've actually been paying attention to uh, the news regarding how well Disney is doing in terms of their revenue, they're not doing really all that well, even though, of course, they've moved most of their business. They're trying to move over into the streaming. They're just not there yet. In a recent article, it says Walt Disney Company loses more than $7 billion this year due to the pandemic. It says the Walt Disney Company said it lost more than $7 billion this year due to the pandemic. It says this loss, while not a huge surprise, means recovery is still a long way off. Disney Parks experiences and products saw about a 2.4 billion impact as a result of the pandemic during its fourth quarter, the company announced during its earnings report on Thursday. It says park revenue for the fourth quarter decreased by 61% to about 2.6 billion compared to the last fiscal year, Disney said. Segment operating results also decreased by 2.5 billion to a loss of 1.1 billion. The total net adverse impact related to the pandemic on segment operating income for the fourth quarter was expected to be about 2.4 billion, Disney said. The lower operating result for the fourth quarter were due to decreases in both the domestic and international parks, Disney said. However, capacity has increased from 25% when the park first reopened to about 35% now at Walt Disney World. And of course, with Joe Biden possibly being reelected, we know that he is in favor, of course, of lockdowns. We're hearing a little more and more within the news recently about what looks like a 4 to 6 week lockdown. Of course, in places like California, where Disney has yet to be able to open up, most of the losses that Disney, of course, has incurred as a result of not being able to open up in California, as Governor Newsom, of course, will not allow them to open up at this time, and there is no current plan for them to open as far as they know. It says the company held a webcast on Thursday, which was the anniversary of the company's now streaming service, Disney Plus, which of course has 73 million paid subscribers. It says Disney goes on to say, even with the disruption caused by the pandemic, we've been able to effectively manage our business while also taking bold, deliberate steps to position our company for greater long-term growth. This, of course, is stated by the CEO. The real bright spot has been, of course, our direct-to-consumer business, which is key to the future of our company. And on this anniversary of the launch of Disney Plus, we're pleased to report that as the end of the fourth quarter, the service has more than 73 million paid subscribers, far surpassing our expectations in just the first year. It says during the earnings call, it says the company announced that Walt Disney World generated enough revenue to cover costs this quarter. Of course, that's Disney World, not Disneyland, where of course they are losing money because it's located there in California. It says in Disney's last earnings call in August, the company said its theme parks took a $5 billion hit after shutting down for several months because of the pandemic. And of course, primarily Disneyland in California remains closed. The company recently laid off 28,000 cast members at its theme parks in Orlando and Anaheim. Disney did not say when it expects to ease social distancing and mass restrictions, but did say it's expecting to spend $1 billion next year to stay open during the pandemic. It says one thing not discussed was if any more employees would be laid off in September. In September and October, Walt Disney World told the state that it would lay off more than 17,000 people by the end of the year. So they've already laid off 28,000. They're expecting to lay off another 17,000. And this is basically how many of these businesses, of course, are trying to do everything that they can to stay open. And a lot of what these businesses are forced to, unfortunately, do is basically work with what the state is allowing them to do. In places like California, where the state literally is not allowing them to open in any way, shape, or form. And so Disney is betting very heavily on their streaming service. But realistically speaking, their streaming service is not doing that great. Even though it's doing better than expected, in terms of actually generating revenue for the company and net positive income, it's not. It says Disney Plus surpasses the 73 million subscribers as streaming takes center stage. The company experienced deep losses in its theme park division because of the pandemic, but investors don't seem to care at the moment. It says here, Disney on Thursday reported an 82% decline in quarterly operating income. The result of steep losses as a result of the pandemic devastated the theme park division, and of course the postponement of major releases, as well as of course things like ESPN, which is also owned by Disney. We've seen a lot of woke sort of material that's been released in the Disney Plus, and realistically speaking, what we're seeing in the current climate is that many Americans, roughly 70 some odd million of them, are leaning away. We've seen that with the NBA. We'll more than likely see that, of course, with Disney as well, because this is a sort of material that they've been releasing lately. So it goes on to say here, it says, to that end, Disney said that its flagship streaming service, Disney Plus, had roughly 74 million subscribers as of October 3rd, surpassing the low end of its initial 5-year goal after only 11 months. Disney also owns Hulu, which has 36 million subscribers, up 27% for the year earlier, as well as ESPN branded streaming services with 10 million, triple number from the year earlier. Disney will soon introduce Star, an overseas version of Hulu, stocked with programming from Disney properties like ABC, Fox, FX, Freeform, etc. It says streaming is not yet profitable business for Disney. Far from it. Losses in the company's direct-to-consumer division totaled 580 million in the quarter. It says, which was less, of course, than analysts had feared, bringing losses for this fiscal year to 2.8 billion. Streaming-related losses are expected to peak 2022 as rollout costs decline and content expenses is normalized, with Disney Plus profitability expected by 2024. That is a long way off, especially with what is going on. There's a lot of uncertainty in terms of Disney. One of the reasons why I had removed it from my portfolio, and I was actually looking at it, and I may take a short position in the stock. Maybe I'll buy some long-term puts on the stock. We'll have to wait. And so there seems to be a lot of uncertainty in terms of Disney and the company, and we're going to have to wait and see if Disney is going to be able to weather the storm of the pandemic.